What we did is in the very beginning of our first class 2 weeks ago, we start with this accounting and explaining what accounting is. So basically accounting is a system which identify is there a transaction or not. If there's a transaction, we're going to record the transactions into the accounting system. So we're going to measure that business activity in form of transaction. We're going to put the transactions into the system. The system is going to process the information, prepare the report, and we as an accountants, or you as managers, we're going to communicate the information to the people who make decisions. What kind of decisions makers we have? We have two types of decision makers. We have internal users and external users. Based on that, we divided the accounting for two parts: financial accounting and managerial accounting. Financial accounting, for the financial accounting, people who's going to go with the accounting, they're going to see on the financial accounting, we have so many of those. Principles 1, Principle 2, Intermediate 1, Intermediate 2, Advanced Financial Reporting. We have 5 courses. On the managerial accounting, we have only 3. We have Introduction to Managerial Accounting, then we have Intermediate Managerial Accounting, and we have Advanced Managerial Accounting. Why is that? Because usually as you can see here in the Principle of Accounting first part, we're going to talk about the financial report itself, and we're going to talk about assets and assets only. Then on the second part, you're going to see liability and equity. On the managerial accounting, that's a different structure. So now, once we saw that one, we come up with the business organizations, and we saw that there are 3 forms of business organization. One was the proprietorship, when we have one owner. The other one is the partnership, when we have 2 owners. And the last one is the corporation. We can have 1, 2, 3, or many. The main difference is proprietors and partnership. There's no separation between the owner and the company. When the corporation, they're separate legal entity. The corporation itself is separate legal entity. And then we saw that in order to prepare all this accounting, in order to enter the transactions, prepare everything in the accounting system, we have to follow some concepts. And the concepts, we have a framework for the concepts. We have the objectives, we have qualitative characteristics, we have the elements of financial reports, and we have assumptions, which are the assumptions of foundation. Then we identify everything in the assets and liabilities. Then purpose of all these reports is to achieve relevance, reliability, comparability, and understandability. That's why we make it simple for the external users. And then the last thing is communicate everything with the users. Once we do that, we're coming to the basic accounting equation, which basic accounting equation is assets are equal to liability plus owner's equity. In other terms, everything that you have, the company has, let's move it to the company level, everything that the company has either belongs to the outside creditors, either belongs to the owners. So economic resources in the company coming from 2 sources, either from the owners of the company as an equity, or either from outsiders in form of liability. And then we saw what the assets are, what the liability are, and what the equity is. And then we talk about the revenue and expenses. But before we do that, remember, let's go to this one, and let's see what increasing the owner's equity, what reducing the owner equity. It's important because question like this is going to come on the test next time. So, owner's equity is affected by owner's investments. Every time when the owner invests, that's going to increase his equity. Every time, on the other hand, every time when the owner withdraw from the business, we're talking about here proprietor and partnership. Every time when the owner withdraw from the business, that's going to decrease owner's equity. And from the operation of the company, what I want you to understand is every time when the company generates revenue, that's going to increase owner's equity. And every time when the company incur expenses in order to generate the revenue, that will reduce the owner's equity. Revenue obviously comes from the main operation of the business through delivering services and or selling goods, where the expenses are always and always related to the revenue. So once we did this, today what we're going to do is we're going to go through this example, those journal entries, but those journal entries now we're going to prepare it in forms of what we did last time in terms of debit and credit now. That's the only thing that's going to change. So what we learned last time was let me see which screen you're seeing right now. What we learned last time, we learned about this accounting cycles, different steps in the accounting cycle. So first, what's happening is company start operations. Okay, fine. Then we're going to see from the documentations that we're going to have, we're going to identify, is this transaction or this event affect the company? If it's yes, then we're going to treat it as a transaction of the company. Then we're going to record it into the journal by using accounts. Those journals, for every each account, we're going to keep it in the ledger. That ledger on the very front is going to have a sheet with all the accounts inside with the current balances of those accounts at that period of time, and that's going to be called trial balance. Today, we're going to start preparing the adjusting entries and adjusting trial balance. So we're going to see what's the difference between unadjusted trial balance and adjusted trial balance. Obviously, the difference will be those adjusting entries. We're going to see what kind of adjusting entries are those and why we have to do those adjusting entries. What else we did last time? We identify that this every account. So imagine I give you example last time as a drawer with different shelves or different single boxes in the drawer or closet with the different drawers. Today I'm going to give you another idea. So imagine this, you have one of those big thick tech notebooks. So every page in that notebook, it's going to be information about every single account in the company. So every page, we're not going to call it page, it's going to be account. In that account, we're going to write debit, means depends if it's asset, debit means coming in, credit means going out. Then we're going to list it first assets. Then we're going to list liability. Then we're going to list equity. On every page, we're going to keep track what's coming in, going out, coming in, going out, coming in, going out. And that will be our journal. Every page will be the account because all the accounts are in the same textbook or notebook. That notebook, entire notebook, will be called general ledger. And on the top, at the very front, on the cover on the front page, we're going to have listed each account in the notebook. And we're going to say the current balance. Currently, cash, we have that much money. Accounts receivable, that much. Equipment, that much. Accounts payable, that much. Equity, that much. If something changes inside, we're going to change the trial balance at the front or the list with the balance at the front. And that's our organization. That's how we're going to organize the entire system. Now, that was a long time ago when the people don't have computers. That's how they come up with this idea. And the double journal entry, let me see, I was always talking to my colleagues about the so the double journal entry was created by, I'm trying to find the person who actually created. It's a monk. The person that created the journal entry, the double journal entry, back a long time ago, he was a monk. And the only reason that he created those double journal entry is to keep proper track of everything that every person has and record from where he get it, how he get it, and what he get. So you get this because you did this. You have this because you did this. It's always like a debit and credit. You get something because you did something. And the other thing that I want you to understand is now when we have those accounts, we're going to organize it again. First, always going to be asset. Second will be liability. Third will be owner's equity. 4 revenue, 5, 6, 7, 8 will be expenses. And we're going to organize it in form of the debits and credits. Based on the accounting equation, assets equal to liability plus owner's equity. Once we have the T account, we're going to draw the T account between the assets and liability owner's equity. And we're going to see on the left side is always debit, right side is always credit. So that means assets always going to have debit balance. Liability owner's equity always going to have credit balance. Based on that, every time when we put debit, that's going to increase the asset. Every time when we put credit, that's going to reduce the asset. On the other side, since the liability and owner's equity have normal balance credit, every time when we put a credit, that's going to increase their balances. And every time when we put a debit, that's going to reduce liability and owner's equity. We went one step further and we said that besides the assets, liability, and equity, we also have owner's withdrawal account, which is special account, which is the opposite of the owner's capital. So owner's withdrawal account, it's gonna have a debit balance because debit balance is opposite of the interest of the owner. So every time when the owners withdraw money, that's gonna give him a debit. So that means he's gonna decrease his capital. And we have those two accounts that's gonna determine how the company is doing for the period. Does the company have income or the company losing money? When the company generates income, that income directly affects the owner of the company. So since the income comes from the revenue always going to be credit because credit is the good for the owner. More revenue, more owner's equity. Expenses are necessarily evil for the revenue, but the expenses reducing the revenue. Sorry, they're not reducing the revenue, they're reducing the net income because the net income is revenue minus expenses. So every time when you have only revenue, that will be income. But every time when you're adding the expenses, that's going to reduce the net income. But expenses, since they're reducing the net income and the owners want net income, that's going to reduce their capital. So for that reason, expenses always going to have normal balance debit. So once we know all those things, let's go back to chapter 1 and let's do those transactions together. So what I'm going to do, I'm going to copy this, the entire sheet here, and I'm going to move to Excel spreadsheet, and we can do these transactions all together in forms of debit and credit the way we did last time. I'm going to post it as a picture, And I can share my screen now. Okay, can you guys see my screen? So once you have my screen, let's start one after another. Let's start with the first transaction. So the owner of the company, Lisa. So let's see what was the whole idea with this company. The company is, yeah. So the Lisa opened her new business, and she invested, as you can see, $25,000 cash to start the business. So what will be our first, is there a transaction related to the business? That will be the first question. Yes, there is a transaction. Next thing, what the company get? The company get cash. So what we going to do? Debit, cash. How much the company get? 250,000, correct? Okay, $250,000 cash. From where the company get it? Now the question is, from where the company get this cash? Who give it to the company? The owner give it to the company. So what that means, the company now start owing money to the owner. And then we have to keep track of now of the owner's capital because he's the one who investing. So we're gonna credit owner capital. Cash gonna increase, owner's capital is gonna increase. So the company has assets and the company has equity for the same amount. Make sense? Next one. The company purchased land for future office location and pay $100,000 cash. What the company get? Land. Let's do it. Debit, land. What's the value of the land that the company get? $100,000, correct? Did the company pay for that land? Yes. How they pay? Cash. So let's reduce the cash. Credit, cash, $100,000. Make sense? Okay. Next one. The next thing that the company buy, they bought stationery, but they agreed to pay within 30 days. So, did the company get something? Yes. What they get? They get office supplies. Let's call it, for simplicity, office supplies. Yeah, we can call it stationery. So basically, when you see transactions like this, and if you put debit stationery, I'm going to accept this as a correct answer. If you go with the office supplies, I also going to accept it as a correct answer. So debit, office supplies. And we get $7,000. Now the question is, did we pay for it? No. Do we have to pay for those ones? Yes. So what if we get something but we haven't paid for it? What that creates for us? Liability, correct. And how are we going to code that liability? accounts payable, right? We're going to keep in account how much we owe, and we're going to call it accounts payable. So we're going to credit liability account, which is called accounts payable here. And that accounts payable will be for exactly the same amount. Why? Because we have to keep debit and credit equal. Next one. Now the company provide the service revenue to the customers, which they automatically collect and convert into cash. So what we have to do here? Number 4. What the company provided? Service. What the company get? Cash. Let's get the cash. Once you see the company getting cash, get that cash right away. Don't leave it on the table. Get it right away. How much cash they get? $30,000. Why they get the cash? Because they provide service. So what that will be for the company? Revenue. Let's go with this. Sales revenue. We can go revenue or we can go sales revenue. Either one is correct. You can go sales, but once you go with sales, give me a revenue. I want to see revenue. When it's revenue, I want you to identify clearly this is revenue, okay? Let's make this. Can I explain why sales revenue? Yes, I can explain that why sales revenue. So why the owner of the company usually opens the company? Let's go back to make money. Usually to make money. Unfortunately, he has to put some effort. Now, the question is from where the money is going to come. Imagine this. I have $100,000. I open my own business. I put the $100,000 into the company bank account. I opened my corporation, put the $100,000 in my account, in the company account. Sorry, not my account now. From my account, they're going to the company account. And the company showing debit cash, credit, owner's capital. Okay. And I'm sitting and waiting. And I'm sitting and waiting. And after 1 week, I'm going to the company and asking, where is my profit? What the company is going to tell me? Am I generate profit? Again, I'm investing $100,000 in my company, put it in the company bank account. $100,000 debit cash, credit owner's capital. 1 week later, I'm going there, and what I'm going to see? How much money I'm going to see in my bank account? What do you think? I'm not doing anything, people. You have to understand. I just give it to the company, and company put it in the bank account, and company doing debit cash, credit owner's capital. And after that, nothing. Absolutely nothing. 1 week after, how much will be the cash in the bank account? After 1 week, the bank's not going to pay you the interest. And if you open the company, that's going to be in the checking account. So the bank usually, they don't pay interest on the checking account. So it's going to be the same amount. But I opened company to generate profit. And I'm asking, why the company doesn't generate profit for me? Is it possible company magically to start doing some activities without me hiring people, putting managers, buying some inventory, selling inventory, if I want to say, is it possible that company by itself to start generating profit? No. What we have to do? We have to have some transactions. So now, if I start having transactions, if I start buying, watch this. If I start buying inventory, I'm gonna buy with 100,000. Buy inventory, buy supplies, buy pay for the rent, pay for the electricity, purchase a land, purchase a building, purchase machinery, and suddenly I don't have $100,000 anymore, but I have all the other stuff. Am I generating profit? By only purchasing and buying. Can I generate profit by only purchasing and buying? No. So what do I have to do in order to generate profit? Make sales. Is that make sense now? I have to generate sales. From where I can generate, what will be the activity that I have to provide to my customers in order they to pay me money? There are two options here. Either I have to provide them services, either I have to sell them items. Make sense? There's no other options here. Either you're going to provide service, either you're going to sell them some item, they're going to buy it, and you're going to profit because of the difference between buying and selling. That's all. So in that case, this company provide the service to the client. So what they generating? Sales. What that means for them? Revenue. They earning revenue now. Make sense now? I went too far in order to explain this, but I want you to understand the essence of doing business. You can spend as much as you want, and you're never going to generate income. Why? Because you're not selling anything. In order to generate income, you have to sell something. Once you sell something, you're going to generate revenue. Because that revenue is going to come from the third party, which is customer. As long as you're the one who putting money in the company and spending those money, that's nothing. There's no activity here. You're just investing in the company. You're not generating income here. The customer has to come in the picture. You have to sell something. That's going to be revenue. Make sense? So that's why here we're going to credit sales revenue. Is the sales revenue what the owners want? Why the owner opened the company? We already said to get profit. From where the profit is going to come? From sales. Not only from sales. Okay, watch this. If you're saying the profit, so watch this. If you're saying that the profit, watch this. If you're saying, just hold on a second for a second. If you're saying that the profit comes from sales, I'm going to give you an example. I'm buying computer. I'm in the business and buying, selling laptops. I'm buying a laptop for $1,000 and I'm selling it for $800. How much is my profit? So from where the profit comes from there? Is it from sales? No, from where the profit comes then? From the difference between sales price and the purchase price. Make sense? As long as the revenue is more than the expenses, you're gonna see profit. And as long as the expenses are more than the revenue, you're not going to see profit. I'm sorry. That's how simple it is. So what you have to make sure that all the operations that you're doing in the company are less than the revenue that you're generating from your customers. So it's good to spend money, but make sure that you're getting revenue from the customers and make sure that the revenue is more than expenses. Long time ago, we were joking, I'm not afraid of the huge expenses. I'm afraid of less revenue. If if the revenue is less than the expenses, sorry, there's no profit. So make sure the revenue is more than expenses. So that's why revenue always going to be credit because it's going to increase owner capital. Expenses always going to be debit because it's going to decrease the owner's capital. So this company, let's say they're generating the revenue, providing the services and get $30,000. Awesome. Let's keep going. I'm going to pull the second from chapter 1. I'm going to go to the next slide and I'm going to copy the next slide and we're going to come back here and we're going to start working again. Let's see what else this company did. We get the first 4 transactions. Let's go with the next. What's happened in the next set of transactions? Let me make it smaller. And let's start discussing those transactions. Next thing, the company performed another consulting services to the client, but they didn't pay. So did we get cash here? No. Do we have to get the cash later? Yes. What's that going to create for us? Receivable, right? And since it's on account, it's going to be account receivable. Thank you, Sophia. Let's go now. Debit. What we're going to be debit? Accounts receivables, yes. Let's go with debit accounts receivable. What will be the credit now? What we provide to the service, to the customers? Sales revenue or just revenue? Credit will be revenue. Or you can go sales revenue. It's both ways is acceptable. For the same amount, right? How much was that? 25,000 here. And we have 25,000 revenue. Make sense? Let's see the next transaction. During the month, now in order to reduce to generate this revenue, we have to have some expenses, correct? So let's start. First, we paid office rent, correct? So let's go. We paid office rent. What will be that for us? Expense. Yes. What kind of expense? Be specific now. Debit. Rent expense, correct? Because we're paying rent, you can go office rent or you can go with the rent expense, either one. Now, another thing, one thing I want you to understand how I'm going to mark your exams, your tests. When it comes to the journal entry, if it's related to expense, I want to see the word expense. If you only put rent, then I don't know what is it. Is it asset? Is it expense? Pretend that I don't know anything about accounting. So you have to tell me what exactly is. If you put expense related to rent, that's acceptable. If you put rent expense, that's acceptable. You're going to get your marks. But if you only put rent, then I don't know what to do with it. Make sense? So make sure you're explicit in communication. When it's expense, I want to see the word expense. When it's payable, I want to see the word payable. When it's receivable, I want to see the word receivable. So now we have the rent expense, $4,000. Did we pay for it? Yes, we pay for it. We pay it in cash. So debit, credit will be cash for the same amount. Next transaction, we paid employee salary. How are we going to call this debit? What is it? When we're paying employee, what is it? Is it asset? Is it expense? It's expense. Let's go with salary. And how much we pay for that? 6,500. How did we pay salary? With cash. Please, when you have employee, make sure you pay them salary in cash. Don't leave it in salary payables. So $6,500. And the last one, we pay for utilities. Which account we're going to use now? What will be the utility when we're using the utilities? So that will be utility expense. That's correct. Debit, utility, expense, and that utility is $1,500. And how we pay? Cash. With the same amount, $1,500. Okay. So let's see if we have any other transaction that we can do here on chapter 1. Yes, we do. We have another 1, 2, 3, 4 transactions. 9, 10, 11, 12. Let's go with the next set of information. Let's post it again as a picture, make it smaller so we can adjust it to our screens. And let's go with the next one. The next
Hi,
one.
I'm
Yes.
audible.
Yes.
So, like we paid 12,000 cash in total. So, can we like debit all expenses and this credit cash for just one time? Is it okay?
Yes, that's a very good question.
Credit.
So that's a very good question. Everybody hear the question?
So,
So the question
like
is,
we credit cash.
so what I want you to understand is, in all those transactions, do we have something similar or something identical? Let's not similar, identical. Similarity is that everything is expense, but the identical is credit cash. So for that reason, what you can do is you can go one step further and you can do what is called in accounting combined entry. When we're seeing on the credit the same account, I can combine those 3 entries into one entry. How can I do that? I'm going to do debit. So I'm going to get the debits, this debit and this debit and this debit. I'm going to put them here. And since the credit it goes to the exactly the same account, exactly the same account, I can easily simply go credit cash. But now the credit, remember the debit has to be equal to the credit. So I'm not going to go cash 3 times. I'm going to go cash only 1 time, but I'm going to make sure that the cash amount, including all the amounts on my debit. Make sense? And in that case, my debit is equal to my credit. So this one is the alternative of the journal entry 6, 7, and 8. Again, because the credit goes to the same account. I can combine those 6, 7, and 8 in one entry, and that will be 6, 7, and 8. And that will be combined entry for those transactions. You can do that. Now on this level, where you are, we are on the third class in accounting. I don't expect you to go with the combined entry if you don't feel comfortable. I want you to keep it simple. But if you feel comfortable to go with the combined entry, go for it. Again, for simplicity, keep it simple. Because the combined entry at this level, might get you confused. I don't want you to get confused. I want you to get confident. Once you get enough confidence, then we can move to the next level. I don't know if that makes sense, but I'm trying to make it easy for you as much as I can. So now let's go for the next one. Let's go now to the number 9. We paying to the store from which we purchased $7,000 office supplies. So the question here is what we did. Let's go back to the office supplies. Once we get the office supplies, did we pay for the office supplies? Do we have to pay for the office supplies? Yes. So let's pay for those office supplies. So the question is, do we buying a new office supplies? Is it clear for everybody that we're not buying new office supplies? We're just paying for something that we haven't paid before. So what we're going to do now in number 9, we're going to reduce, what we're going to reduce? Our accounts payable. How are we going to reduce accounts since it's liability? On the debit side, we're going to reduce it. And we're going to pay $5,000. How are we going to pay that? From where are we going to get those $5,000? From cash. $5,000. Now let's see number 10. What's happened number 10? Lisa remodeled her home and she paid cash from the personal funds. What are we going to do with number 10? No entry. Or not applicable. Or simply no. Anything that makes me understand that you understand that this is not related to the business, we're not doing anything. If you see transaction like this, the owner purchased flowers for his significant one for that much, that's great, very good. Please do it more often. If you can do it every day, that will be perfect, but from your personal money. That's not part of the business. I'm sorry. So where is the 2000 difference? So there's a question here. We purchased something for 7,000. We didn't pay 7,000. Now we're paying 5,000. Where is the difference? Well, did we pay 7,000? Difference will stay in accounts payable. So what that means, we still have to pay these people $2,000 more. When we're gonna pay it, that's a different story. That's why we keep track of our accounts, and we know that from the 7,000 accounts payable, we pay only 5. We still have to pay another 2,000. Make sense? That's why we're keeping accounting. Imagine if we don't have accounting. We're buying something for $7,000. One day we're going, take $5,000. And we're done. Why? Because we're not keeping accounting. He doesn't remember how much we purchased. We don't remember how much we own. We just pay $5,000. Are we done? Yeah, sure, whatever. If that's how we're doing accounting, that will be perfect, right? Imagine this. You're working for somebody, for your employer, he has to pay $2,000 and he pay you $1,000 and he say, we're done. Are you happy? Obviously, you won't be happy, right? You want to pay for as much as you want work, that's how much you want to get paid. So let's see the next one. The business collecting $15,000 from the client as a partial payment for the consulting services in the transaction 5. So what's happened in transaction 5? We provided the service, the client didn't pay. Now the client pays. What did we get? Number 11. We get the cash. Yes, cash. Yeah, we get cash. Finally, we get what we wanted. Makes makes sense. Why the company? So now the next question will be, why the owner of the company opened the business? Usually you're getting to get profit. Well, is it actually he chasing profit or he chasing cash? Or he chasing profit in forms of cash? Because if I generating profit and you go to the superstore, but I'm not collecting my profit, everything is accounts receivables, and you're going to superstore and say, can I buy can I pay with my profit? What they gonna say? Can you pay with profit? No. How can you pay? With cash. Sorry. If you have a cash, you can take the milk. If you don't have a cash, have a nice day. Simple, right? So we want cash. So how much cash we getting here from this transaction? We're getting $15,000 cash. Let's get $15,000 cash. 1, 2, 3. And then credit. From where this cash came from. Now, question for you. Did we provide services when we get this cash? When we get $15,000 cash, did we provide the services? This is amount due. Yes, we're not providing services. We already provided the services. We haven't collecting the cash. Now we're collecting the cash. So this is another common mistake that you're doing. Every time when you see the cash coming for the services that haven't been paid in the beginning, you're still going back to the revenue. Don't. You're not generating new revenue here. You're just collecting accounts receivables. Make sense? So we're going to reduce the accounts receivables. Because if you go back to the revenue, what's going to happen? Let's think about it for a second. What's going to happen? So you're showing me here revenue of $25,000, correct? You're showing me this 25,000 revenue. And when you're collecting the cash from the revenue that you haven't collected here, if you're showing me here another revenue of $15,000, how much will be total revenue that you're going to show me? $40,000. How much cash of those $40,000 you're going to get? Only 25. Make sense? So technically, you're collecting $25,000 only because that's your actual services that you provided to the customer. You're showing me revenue of $40,000. What's going to happen when you do your tax return? When the Canada revenue see this, that every time when you're collecting the cash, which you haven't collected in the first place when you're providing the revenue, you're still creating the revenue. Canada revenue is going to send you on every Christmas and every Easter, they're going to send you thank you postcard. Please do that more often because you end up paying more taxes for the revenue that you're actually not collecting, and it's not revenue. Please do this mistake more often. Make sense? So every time when you're collecting the money, make sure you understand that you're not generating the revenue. You're just collecting the accounts receivable that haven't been received in the first place. And the last thing, what's left? The last thing, the owner of the company withdraw $6,000 for personal use. What we're gonna do here? 12. Debit. Which account we're gonna debit now? Owner's withdrawal. Let's go with the owner's withdrawal. Of $6,000. And how he get those $6,000? Cash, credit, cash. $6,000. And we're done. Correct? Make sense? Okay. So let's do one example here. I want to see how this one flows. Just give me a second. I want to check very quickly. I want to check something to make sure that you're getting what I'm getting. And we're going to go with one interesting example. And I want you to go to all of it. Can we put owner expenses? There's no owner expenses. There's no such account owner expenses. Every time when the owners take money, that's not that's a withdrawal. In his personal accounting, you can put it owner expenses, but for the company, that's owner's withdrawal. What kind of journal is this? Trial balance? Not. This is just journal entries. Right now, we're doing journal entries and journal entries only. I'm trying to find something so we can move to the next level, which you're going to see the implication and explanation of everything. Just give me a second to find the right proper question, and I'm going to give it to you and we can do it together. Just give me a second. Trying to find one question which is interactive. So basically, once we do something, it's automatically gonna put everything on the right places. Okay, I found something. Okay, let me post it for you, and just a second, I'm gonna give you access to it right away. I'm gonna post it in Blackboard under chapter 3. Just give me a second to go there, and I'm gonna post it there, and we can do it together. So in the first transaction, what's happened in the first transaction? She invested $15,000 cash, debit cash, create owner's capital. The second transaction is, let's erase this date. On the second transaction, she purchased equipment. Did she pay for the equipment? What do you mean? How do we know it's a credit? Which one? There's a question in the chat board. How do we know it's a credit? The capital, it's capital in the question. How do we know it's a capital question? Well, if the owner invests money, the owner gives cash. What the owner gets? He gets capital. He gets owner's account. Make sense? He giving his own $10,000 to the $15,000 to the company, and automatically he become an owner of the company. So his capital account will be this exactly the same amount that he invested in the company. Make sense? So let's go with the next one. Next one, she purchased this equipment. So debit, which account we're gonna debit now? Equipment, right? Did she pay for the equipment? That she has to pay for the equipment. Yes. So which account we're gonna credit? Accounts payable. Correct? How much that equipment worth? $12,000. In the next one, next transaction, letter C. What happened in letter C? The business rented, sorry, additional kiteboard equipment for 1,500 on account.
Correct.
So let's get additional equipment, debit, more equipment, and credit will be, did we pay for it? Accounts payable. Credit, accounts payable. What happened here? We have equipment for 1,500, and the accounts payable is $1,500. Next one. She paid $400 to cover the insurance for the month of June. So if she pays that insurance, which she using it for the business, what will be that for the business? That will be expense. What kind of expense? Insurance expense. So that will be debit, insurance expense with how much was that? $400. And she paid right away cash. And that will be here credit, cash with $400. And we're done with this. Next one. The business provides lessons to a group of clients for $3,500 on account. Now, what we're doing right now, we finally start providing the services. We finally start generating the revenue. Did we collect the revenue? No. Which account we gonna debit then? Accounts receivable. And how much will be that? With $3,500. Credit. Which account we gonna create? Revenue. Or sales revenue, whatever you want to call it. $3,500. And we're done with this. The last one is the business collected $2,000 from the credit customer. So the customer that who didn't pay us, he $3,500, he pay us $2,000. So what will be that? What did the business get? Debit. Cash. How much cash the business get? $2,000. Why the business get $2,000 cash? Is it because the business provide a new service to the client, or because the business collect the money from the client? They collect the money from the client. So what will be that? Credit, accounts receivable. With $2,000. So we're done with the journal entries. If you want to sell now, what we can do here on the journal entries, interesting thing is, let's run the total of the debit and let's run the total of the credit. First thing that we have to find out is the debit equal to the credit? And we're seeing that the debit is equal to the credit, correct? So that means we did a great job. First thing, when the first principle of accounting was followed, debit is always equal to credit. So that whatever it's on the debit, the same amount is on the credit. You can check the entries to see if we did correct. The only thing that we didn't do correct is the rent expense on the equipment expense, on the equipment that we rent the equipment. That's the only thing that we basically missed this one. It's expense. So we can go back and change only that transaction here that we rented the equipment, and we can go with the equipment rent expense. That's the only change that we can do. Everything else seems to be perfect, right in order. So now, what we're gonna do from here, from this point, what we're gonna do is, since we have everything on the journal, we're gonna go to the T accounts. We're gonna go now to the ledger. where we're going to see all the T accounts. We know what we need. We need cash. We need accounts receivables. We need the equipment. We need accounts payable. We need the owner's capital. Owner's withdrawal. She didn't withdraw any money, so that makes it easy for us. That's not a revenue. We're not gonna have this teaching revenue. We're gonna have only revenue here. And we're gonna have the equipment rental and insurance expense. So that teaching revenue, we can eliminate it because we don't have anything. So let's go with the cash. Question for you. What was the beginning cash at the beginning of June 1st? How much was our beginning balance? No. That's after she put the money. Before she put the money, how was the beginning balance? When she opened the company? Zero. The balance was zero. How about accounts receivables? Zero. How about equipment? Zero. How about accounts payable? Zero. How about capital? Zero. How about withdrawal? Still zero. The owner's withdrawal will be on the debit side, so we can put it here, zero, here on this side, rather than the other side. So what I can do is get those one and flip it here and make it correct. Now the revenue and expenses we're going to see later, they don't have a beginning balance and ending balance. So we have our beginning balance. Then what's happened next with the cash? The first entry, she put $15,000 cash. Now let's go here and put $15,000 cash. And why she put $15,000 cash? Because she invested in the company. So what's going to happen? The cash is going to go up with 15,000. What else is going to go up with 15,000? We already did it. If you don't remember, go back to the journal entry and see capital goes up. Let's go here on the capital and let's increase her capital with $15,000. Make sense? Let's do the second entry now. Business purchase equipment, but didn't pay for the equipment. So the equipment's going to go with 12,000. And accounts payable is going to go up with 12,000. Let's do the T accounts and let's do it. So equipment balance was zero. Then we purchase equipment for 12,000. Let's get those 12,000 here. But we didn't pay for it. So accounts payable is going to go with 12,000. Make sense? Okay. Let's see number 3. What's happened with number 3? That will be rent. We rented the equipment, but we didn't pay for it. We changed this one to rent expense, if you remember. So let's go now to find the rent expense. Equipment rent expense. Go up with 1,500. And since we didn't pay for it, accounts payable will go up with 1,500. Are you guys following me?
Here.
Okay, let's go do the next one. Insurance expense goes up with 400 and we pay for it cash 400. So let's go now and increase that insurance expense with $400. And let's reduce our cash going down with $400. Next one. We provide revenue to the customer. The customer hasn't paid us. So we have accounts receivables going up with 3,500 and the revenue goes up with 3,500. Let's go and show this accounts receivables 3,500 and the revenue goes up with 3,500. And the last transaction was the customer pay us $2,000 from the revenue that haven't paid in the first place. So what we have to do, we have to increase our cash with $2,000 and we're going to reduce our accounts receivables with $2,000. And we're done. No more transactions here. So what we're going to do here, we're going to get the total debit and credit. That will be one way. That's the longest way to do it. I'm going to show you this only on the cash. And after that, I'm going to go with the shortcut. One option is get the total debits, get the total credits. Next calculation is to the total debit, add the beginning balance plus the beginning balance. Credit's going to stay the same. And the ending balance is going to be beginning balance plus the debit minus the credit. Make sense? On the other accounts, I'm going to go the shortcut. Shortcut is get the beginning balance plus, since we have only one debit, plus the debit minus the credit. It's going to give you ending balance. For the equipment, same idea. Beginning balance. Now we can copy and paste. No, that's not going to be the one. That will be equal to beginning balance plus 12,000. And since we don't have anything else, that will be the only balance here. In accounts payable, we're going to have the beginning balance plus first not payment amount and the second amount that we didn't pay. So we're going to have accounts payable of that much. On the owner's capital, the owner's capital in the beginning was 0. And then the owner invested 15,000 and that's our capital. Withdrawals, there's no withdrawals. So that will be 0 balance. There's no teaching revenue, nothing here. But on the revenue, on the other revenue, we're going to have $3,500. On the insurance expense, we're going to have total expense of $400. And the equipment rental expense, we're going to have total rental expense $1,500. So once you do this with those accounts, this will be your journal ledger with all the accounts, what's happened in the account, plus, minus, and the ending balance. Now, from here, once we do this, we can go to the trial balance. If you click on there's a worksheet that says trial balance. Click on that trial balance. And let's see what's going to happen now. First, we have to put the name of the company. And this company name was Cara Morris. Was that the name of the company? Cara Kate Adventures. So I'm going to get this name from the Word document, which I have it open. And on the trial balance, what we're going to do is I'm just going to replace this name. Those dots, I'm going to replace it with the name. Increase the font, and we have the name. Trial balance, and that will be at June 30th, 20 something year. Doesn't matter. The year doesn't matter at this point. That's not important, the year. Now, the next thing that we have to do is to transfer all the balances that we have on the T accounts here into the trial balance. We're going to change this teaching revenue because that bothers me. We're going to stay only revenue, not teaching revenue. So let's go with the cash. How much was the balance of the cash? We're going to go here and we're going to see that our balance of the cash was $16,600. And we're going to get it. So my cash is $16,600. Accounts receivables. We know accounts receivables, it's an asset account, so a balance should be debit. We're checking here, balance is debit, move it there. Equipment, same thing. We're going to go to the T account. We're going to see how much is the equipment. We're going to transfer it here. Then we're going to go to the accounts payable. Accounts payable. Now we're moving to the liabilities accounts. Liability accounts naturally have a credit balance. So we're going to go on the credit side and we're going to move this credit balance on the accounts payable. Owner's capital is the equity account. So naturally that's going to have credit balance. So we're going to move here, going to find this owner's capital, and we're going to transfer that balance here. Owner's withdrawal account on the opposite side, they're going to have debit balance. So we're going to check on the T account. The owner's withdrawal was zero balance, so we're adding 0. Now we're moving to the revenue. We have only one revenue from the service that we provided, and we're going to check that revenue. That revenue was $3,500, and we're going to move it here. Revenue has the credit balance. So now let's see the expenses. Expenses, we have insurance expense for $400. And then we have equipment rental expense for $1,500. This is your trial balance. As you can see, the difference between the journal ledger. On the journal ledger, you have all the accounts with all the transactions, beginning balance, ending balance, beginning balance, ending balance, everything. Where on the trial balance, on one sheet, you can see what accounts you have, what's the final balance, June 30th. Nothing more, nothing less. If you want to see from where this 6,600 goes, then you have to go to open the journal ledger, go to the ledger for the account cash, and see what's happened in cash. And you're going to see my beginning cash was 0. Then owner invested $15,000. Then I pay for the insurance $400. Then I collect $2,000 from accounts receivables. So in total, cash coming in was $17,000. Cash going out $400. So my balance is $16,600. And you can see it on your trial balance. Once we're done with the trial balance, what we can see is where are the totals. And once we get all the debit here and all the credit, we have to be in balance. Why? Because it's a trial balance. Debit has to be equal to the credit. Why? Because we follow the simple accounting rules. Asset equal to liability and equity, and debit is also always equal to the credit. And as you can see, we're in balance. So from here, what we can do from here? We can start preparing simple financial statements. What's the first thing that the owner of the company wants to know? When you open the company, why did you open your company? You said before, because you want to generate what? You said before, say it again. Can you guys hear me? Why the owner of the company opened the company? Because he wants to generate profit. How are we going to find out if the company generating profit or not? From the first statement, which is called income statement. So once we go to the financial statements here, we're going to see. Let's prepare for the CARA income statement for March 31st or June 30th. Let's go with the June, because I believe it was June, and that will be June 30th. So once we do this, what's the first thing that the owner chasing? Owner wants to know how much revenue I'm generating. So from the trial balance, we're going to extract the revenue and we're going to plug it here. So the revenue is 3,500. But then we have expenses. We pay for the insurance. We pay $400 and we pay for the equipment, $1,500. So my total expenses are 400 plus 1,500, $1,900. So is the company generating income? In other words, is the revenue more than expenses? In this case, yes. Can you guys see it? Are you with me or you're falling behind? Okay. Stay with me for now. You're gonna have, this file is for you. You can check your answers later. For now, stay with me. So now, the next thing that I want you to prepare is since we find out the company generating income, that's awesome. Now let's see, where is the owner capital? I have to change it here from June. I believe it was June. And this one is June as well. So, owner's capital in June 1st. How much was the owner's capital in June 1st? Before the company started? Was zero, yes. Then the owner invested. How much the owner invested? We're gonna check we can do it when the trial balance, the owner invested $15,000, correct? Now, in total, the owner's capital is 0 plus 15 So in total, it's $15,000. Then, did the owner withdraw money? No. Did the company generating income? Yes. How much company generating? So now what we have to do, we have to add, in this case, we have to add the net income. And the company generating exactly $1,600. So in total, we have to add 0 plus 16. So we have to add $16,000. So how much is the owner capital at the end of June? $16,600. Now the owner's capital we're gonna represent as of June 30th. The owner's capital is gonna represent the equity. Make sense? The last thing that we have to do is to see, do we have assets in the company? Yes, we do. What the kind of assets we have? We have cash. How much cash we have? From the trial balance, we can see I have 16,600 cash. Do we have accounts receivables? Yes, we do. How much is that? From the trial balance, we have 1,500 uncollected amount, which is sitting for receivables. And we have equipment. How much is that equipment? $12,000. So my total assets are $13,100. Next thing, do I have liabilities? Yes, I do. How much I have? I have accounts payable for $13,500. And that's my total liability. I don't have any other liability. That's my total liability here, $13,500. So how much is my total liability plus, sorry, that will be liability plus equity. Actually, it's not going to work that way. That one will be here. Let me change this formula here. That will be equal to total liability plus owner's equity. It's going to be $13,100. And now, as you can see, we are in balance. So what we just did with this question, we went through everything possible with the whole accounting cycle. From the transactions, recording transaction on general ledger, transfer the transaction from general ledgers into the T accounts, calculating the balances on the T accounts, and preparing the trial balance. And from the trial balance, we prepare the simple financial statements. Remember, the first statement that we're going to prepare always and always is the income. Why? Because the owners of the company always wants to know how much income the company generates. Second question they want to know is, of that income, how much is mine and where is my capital account at this moment? How much I have in my capital account? So this capital account, this calculation, it's going to come for your test next time. So what do you need for this calculation? You need owner capital, beginning balance. You need how much the owner invested, how much owners withdraw, how much company generating from operation. So you need to calculate it. The only thing that you need to calculate is the income. So the beginning balance is going to be given to you. How much owners invested is going to be given to you. Withdrawal is going to be given to you. The only thing that you have to put effort is to calculate the net income. And the net income, you're going to calculate it when you calculate the revenue minus the expenses. And once you beginning balance plus the investment plus the income minus the withdrawal, it's going to give you the total amount. Do you have to prepare this statement? No. I just want to simply to make a calculation. Beginning balance plus investment plus net income minus withdrawal give you the ending balance. That's all. Simple, no statements, nothing. Just keep it simple. So once we calculate this, the owner wants to know, okay, I understand how much company generates. I understand how much is my capital. Now tell me what kind of resources I have in the company and from where those resources came from. So we're going to tell him, at this moment, you have cash for $16,600, accounts receivable of $1,500, and equipment for $12,000. In total, you have assets for $13,100. Out of those assets, you owe to outside people in accounts payable $13,500. Once you pay the outsider, the rest is yours. $16,600 belongs to you. But first you have to pay the accounts payable. And then there can be different questions. Make sense? Now let's go to slides. I'm going to finish this one. And I'm going to stop sharing this. I'm going to go to the slides. And I want to finish this chapter 1 with the slides. So once we have those transactions, which we already made, if you remember, next thing is to prepare the financial statements. The same way we prepared just right now. So what we're going to do? First, we're going to calculate. We're going to get the revenue. We're going to deduct the expenses. We're going to get the total expenses. And we're going to see the net income. Net income is the one that the owners want to see. That's why the income statements always goes to first. Once they find out how much income they make, they want to know where is my balance on my capital account. So what we're going to do again, beginning balance plus investment plus income minus withdrawal. It's going to give you how much capital you have. Once I found how much capital I have, the capital automatically is going to become total equity. Then the next thing that I have to find out is what other resources, what are my resources in the company? And I have cash, I have accounts receivables, I have office supplies, I have land. Plus I have liability. Once I pay the 2,000 liability, everything else is mine. So from the resources, the total assets that I have 2,890, once I pay 2,000 to the accounts payable, the rest belongs to the owner. That's what the owners wants to know. And that's how we finish this chapter 1. Now, what's the relationship between the statements? The relationship between the statements is from the income statement, that's why income statements comes first. From the income statement, we're going to get that income and we're going to plug that income to the owner's capital. Once we increase the owner's capital with the income, we're going to calculate the owner's balance of his account or his capital. That will become our equity. And that's your link between one statement and another statement and another statement. So remember, income statement always comes first. Then we have to calculate the owner's capital. And the last thing that we have to do is to see what kind of resources the company has, to whom those resources belong to. Means preparing the balance sheet. So we now completely finish chapter 1 and chapter 2. What I want you to do at this point, I want you to focus now on your first quiz 1 in Blackboard. You have 5 multiple choice questions from chapter 1, 5 multiple choice questions from chapter 2. I want you to do the quiz 1 if you haven't done it yet. And then I want you to start thinking for the test for next week. So for the tests of next week, you're gonna have
Wait, sir. When are we supposed to submit the quiz?
quiz is due, I believe, on 26th.
Okay.
So you have to do it this weekend. The quiz is for 60 minutes. I'm gonna send you a reminder. After the class today, I'm gonna send you a reminder for the quiz. So now you have everything that you need to be successful on the first quiz.
Excuse me, sir.
Yes,
Sir, does the quiz and the test are two different things?
absolutely.
Okay,
The quizzes,
thank you.
so the quizzes are in Blackboard. So where you can find it on Blackboard, if you go, let me share my screen. Sorry, I thought that I closed the window here, but I haven't closed it. That's perfect. So where you can find the quiz. Let me share my screen again. The quiz, you can find it if you go to your course. You're going to have sections: course material, course content, quizzes. Under the quizzes, once you open the quizzes, it's going to pop up and you're going to see quiz number 1. And it's due on May 26th. Can you guys see it? That's
So
why
do we need to do this quiz on my lab or we can email you by making a PDF?
What do you mean? No. There's no quizzes on MyLab. On the MyLab's assignments. Those quizzes directly on the Blackboard. You have to come here, open the quiz, finish the quiz. Once you finish the quiz, your marks automatically is gonna come on the Blackboard.
Okay. Sir, actually, I'm also having problem while accessing my lab.
Okay, stay after the class and let's talk after the class, please.
Okay, sir. Thank you, sir.
You're welcome. So that's for the quiz. So now on the test, which will be in class. Now listen to me carefully. On the test, you're going to have 3 questions. Now, one of the questions will going to look very similar to, I'm going to go back to the Blackboard. If you go to course materials, if you go to, no, not the course materials, sorry, course content. If you go to chapter 1, and if you scroll down, cases for practice, and you're going to see here chapter question 1-2, I believe is. Let me see if that's the one. Yes. Question 1-2. So the question on the test will be very, very similar to this question. What's in this question? Let me share that question. We did it last time. I'm going to remind you again in case you forgot. Let me open it on my screen first, and then we're going to go over this. What you have to do on this question is very simple. Information is going to be given to you on different accounts. And then going to be question asked. First question, it might be, how much is the total assets? What's the amount of the total assets on the accounts listed? So what you have to do, you have to identify which one of those accounts are asset accounts. So, for example, that means you need to know which account is asset account, which account is liability account, which account is equity account, which account is withdrawal, which account is revenue, which one is expense. Once you know that, everything will be easy. Second question will be, how much is the liability? Now, for the liability and for the assets, what I need you to understand is if it says prepaid expense, what kind of account is? And if it says earned revenue, what kind of account is? We already talked about this last time. Refresh yourself. Last time I give you a list with the different type of accounts, and you did very well. I was impressed how well you identified the accounts. Same thing you have to do on your test next time. So every time when you see prepaid expense, remember that's an asset account. Every time when you see unearned revenue, remember that's liability account. The question also going to ask you, how much is the total expense? So again, if the account is prepaid expense, don't include it in the expenses because it's not expense account, it's an asset account. Calculate the total expenses. Then you have to calculate the net income. So again, get the revenue, don't get the unearned revenue because unearned revenue is liability account. Get the revenue, check how much is the total expense, get the net income. And the last question is going to be, how much is the owner's capital at the end of the period? So what do you have to do? Beginning balance of the capital plus investments plus net income from the calculation that you already calculated minus the withdrawal is going to give you the capital account at the end of the period. So again, based on the information like this, you're going to be asking those type of questions. Definitely net income, definitely liability, definitely owner's capital. Next thing that you're going to see is simple transactions. And you have to do the journal entry, debit and credit. Very simple. Nothing scary, nothing like that. So now, you might have opportunity to do the combined entry on some of the transactions, but I would strongly suggest you to stay with the simple entry. At this level, I don't expect you to go crazy. Stay with the simple entry. Before we continue further, I want to show you something and I want to make sure that you understand something. I'm going to share my Excel spreadsheet on the first question that we did today. If you still remember that question. So, as you can see, owner invested cash, correct? The very first transaction, the owner invested cash. Can you guys see it? So now listen to me carefully. What's going to happen if the owner decide to invest? The owner don't have I mean, he has a cash, but he also wants to invest computer, which worth $2,000. What will be the journal entry? Owner investing in the business computer, which is high-tech computer. He just give it to the business, and that computer worth $2,000. What will be the journal entry here? What the business get? Debit. Computer or equipment, yes, for $2,000. Now credit. Which account are we going to create? Owner's capital. $2,000. Why no cash? Can I create cash? No. Why not? Tell me why I cannot create cash. That's partially correct, partially incorrect. So who's going to tell me why here I'm going to have owner's capital, not any other accounts? That's exactly what it is. It's put in the business by the owner. The business has nothing to do with that computer. That computer was given to the business by the owner. The business didn't purchase the computer. The business don't have to pay for the computer. It's already been paid long time ago. Right now, the owner just give it to the business. And yes, debit computer, credit owner's capital. What else the owner can invest in the company? Give me another examples that the owner can invest in the company besides cash. Land. What else? Supplies. What else? Be creative here. Can the owner invest his employee? Yeah, that's interesting. Now, we're gonna come to this one a little bit later. Remind me to tell you that when employee actually is going to be asset. So far, employee is not on the balance sheet, right? It doesn't matter. Stock investment. Yes, he can invest investment. Yes, but he giving up that investment. The other thing that I was looking is apartment. He can invest the building. He can invest machinery. He can invest equipment. He can invest so many things, right? Anything that's different than cash. Is this going to be valuable for the business? Definitely. So, Sophia, remind me later when we go a little bit more in the course. I'm going to give you examples about when the employee is actually asset for the company. Now it's a little bit too late to explain. So that will be the second type of question. So you're going to see transactions like this, and you're definitely going to see the owner investing something other than cash. So if it's something other than cash, get it and make sure you create owner's capital. And the last question will be super simple question, which means super simple question means this. Let me stop sharing this, and I'm going to give you another example here. On the Excel spreadsheet, the last Excel spreadsheet that we did with the link between the different accounts, let's go back here. Let me share my screen. The last question that's going to be, I'm going to list you different accounts. Let's say inventory. And I'm going to ask you on which statement, financial statement, that account's going to appear. So if I tell you inventory, on which statement, you have three options here. Income statement, statement of owner's equity, balance sheet. Inventory, on which statement is going to appear? What you going to say? Balance sheet. That will be the right answer, balance sheet, right? If you have owner's capital, on which statement is going to appear? Statement of owner's equity, correct? If you have owner's withdrawal, on which statement is going to appear? Statement of owner's equity. If you have a revenue, on which statement is going to appear? Income statement. If you have expenses, let's say salary expenses, income statement. So that's what that will be the third question. So I'm going to give you a count, not too many, 5 or 6. You have to tell me on which statement you're going to appear, and you have three options here: income statement, statement of owner's equity, balance sheet. So what you have to remember is three statements: income statement, statement of owner's equity, balance sheet. Nothing more, nothing less. And then again, simple transactions. And don't forget, the owner is going to invest something different than cash. Be careful with that one. And the last, obviously, there will be tricky questions on the when he purchased diamond ring for his fiancée, or the company decide to fill application for, I don't know for what, for something else. But you have to identify, is this transaction or not? Is it related to the business or not? All right, that was recap of chapter 1 and 2, plus help for you for the test. The last resource that you have on the Blackboard, there's one special section that says practice question for in-class test 1. Take a look at those questions. I'm not going to spend time now because you have it available on Blackboard. Take a look at those questions, please. Now I can start with chapter 3. Let's go a little bit to chapter 3. Now you can relax and listen, rather than we're not going to have time for the remaining time. We're not going to have time for anything else. Just for you to listen. We're not going to do any questions from now on. So probably I'm going to stop this recording at this point, and I'm going to start a new recording.